when people are managing somebody else's money, they themselves don't know how to manage their own money. And I have seen that.
I got to do what I loved, which was a blessing. And then my life changed. It went from me just traveling and having fun to building a business. And we had to raise money from investors. So I had an added responsibility on my shoulders. And then my wife and I had our first two kids. So that was my introduction into managing a lot, increasing my responsibilities. Our total cost was about $16 million for our acquisition, for our construction cost, and financing costs as well.
Hello and welcome everyone. Today's episode, we have with us awesome guest, Mikey Taylor. He's a seasoned entrepreneur, real estate investor, a politician. He's a mayor pro tem for Thousand Oaks City in California, who emerged from the world of professional skateboarding. Mikey is the co-founder and current president and managing principal of Communal, a real estate equity firm managing $325 million in AUM. Hey, Mikey, I'm excited to have you on the show. How are you doing today?
I'm doing well. Thanks for having me.
Mikey, so you wear so many hats. I know you are married. You have married for last what 15 years and four kids. So and then you have all these different aspects of yourself. What's most challenging?
Time management. I would say that the hard part about doing a lot is it is time management, and it's making sure that the things that you want to be impactful on are getting your attention. You need to be careful that by taking on more, you're not diluting any ability to do something great. It's taken me time to be able to manage what I'm managing now. Big thing, I think, is creating kind of my goal sets, what I'm trying to accomplish, and then making sure that I'm scheduling my time in a way where I can actually, drive those key factors forward. And that means I've had to set rules. I've had to set, what can happen so that I say yes to something. And then probably more importantly, I've had to create the boundaries on what will get a no out of me, and really probably learning the value of no over the years.
Absolutely, no is very important. I think no is more important than a yes, right? And I myself had to learn it the hard way sometimes. And we still make mistakes, right?
Yeah, and like no sounds negative. And so it just feels like you're closing doors, not opening them by saying it. And that was really the thing I had to work through. But then probably the more important part is you have to start valuing your time. And if you're saying yes to everything, not only are you not valuing your time, but you're allowing your focus to go in too many directions, and then you're not getting anything done. So that was a learned skill for me to accomplish.
So let's discuss about your journey so far, right? So you've been different businesses before professional skateboarding. So what's your life before Commune Capital? So let's touch base on that.
Well, in the beginning, I was a pro skateboarder. I was a pro skateboarder for about 14 years, and my life was fun. Like I traveled about 6 months of the year. I had been around the world more times than I could remember before I was even 25. It was a really cool lifestyle. I got to do what I loved, which was a blessing. The challenge I had is I didn't make enough from skateboarding to retire after my career ended. That doesn't happen in this industry. And so I had to figure out what was next. And that part was really scary for me. What I landed on is I eventually started a craft brewery in San Diego. And this was like 2011, 2012 time where the industry was having a big growth moment. And then my life changed. It went from me just traveling and having fun to building a business. And we had to raise money from investors. So I had an added responsibility on my shoulders. And then my wife and I had our first two kids. So that was my introduction into managing a lot, increasing my responsibilities, and it felt like I was drinking out of a fire hose. That was a tough time in my life.
Yeah, I had a retail business myself. So we started a salon back in 2016. And retail business, man, I can tell you, I can relate to it. And food business even more than that, man.
Yeah, it's hard.
That's up to you. It's
Yeah,
hard.
it is hard. So back then, if you would have asked me how my relationship with my kids and how my relationship with my wife was back then, I probably would have told you good, but in hindsight, it was not good. They were the ones that took the brunt of that moment, and that was hard. There was No such thing as work-life balance back then.
Yeah. And then you successfully exited that business. So let's talk about that exit story here.
So we had an idea that we thought would take us out of a red ocean scenario because, even though craft beer was having a lot of growth, there were a lot of new breweries coming into play during this time. So there was a lot of saturation. And we had this idea that we thought would kind of put us into a space of our own. And we ended up being right in that. And the two components were, first, at the time, craft beer was a very, like, it had a high alcohol percentage and it was a heavy drink. So you might have one IPA and that was it. It felt like you had a steak dinner. And so the first kind of component of disruption that we went after was creating an easier or a more sessionable beer, but still living inside the craft beer space. So not a light lager. We were trying to still be in the craft beer space, but we wanted somebody to be able to have more than one if they chose without destroying themselves. And then the secondary part was our marketing initiative. And at that time, breweries didn't really create brands and they definitely didn't use social media to get their product out there. For us, we built the entire business off Instagram and we used a marketing strategy that highlighted our ambassadors over our product. And in 2011 and 12, there were no influencers back then. So we were really early on that concept. What that looked like, all of our marketing was on, let's say, Paul Rodriguez, who's, the Kobe Bryant of the skateboard world. And we would do a little 5-minute documentary on him and more specifically his view of California. So we were painting the California lifestyle through the lens of our investors. But in the beginning of every video, it said presented by St. Archer, which is our brewery. And that just, it worked. It resonated. People started drinking our beer, which made them feel like they were aligned with us on what California was. We then became one of the fastest growing breweries in California. And then that led to really Anheuser and Miller Coors in a bidding war to buy our business. We ended up having a very large exit. And then, the Cinderella story of myself and two partners that had no business experience, no experience in the beer industry, raising money from friends and family, and we're able to we ended up giving about a 13x multiple to our investors in about 4 years. It was just a really, really cool story and outcome and opportunity.
Awesome. And how did real estate, like Commune Capital, kind of came into place? Now you are into skateboarding and then you are into brewery. Real estate is a totally different animal.
This all happened when I was skateboarding, actually. So my original plan to what I thought was to protect, or maybe better said, own my future, was to be very, very smart with my money. I had somebody come into my life when I was 19 years old and really taught me the foundational aspect to financial success, very basic things: credit, creating a budget, asset allocation. And then probably the most important part on the asset allocation was I need to be investing in things that are going to potentially, hit my desired outcome, which was I was 20 years old. I wanted to build my wealth, but I was also looking at having income streams so that I didn't have to rely on my sponsors when my career ended. I could rely on my investments. The hard part was I wasn't making a crazy amount of money. So for the first 10 years of my career, my whole model was live like I was broke to maximize the amount of money I was putting in every year, and then putting that into investments that would be there for me basically when my career ended. And I eventually got to the point where I could start investing in real estate. I started in storage. I then started making some investments in a debt portfolio to give me, a little bit more cash flow or yield. And that was my plan. When we sold the brewery, I started investing much heavier into real estate. And then when my non-compete was up, or the more fair way to say it, when I left and stopped having anything to do with St. Archer after Miller Coors acquired us, I started thinking about the next company. And during that time, I had a lot of athletes calling me asking how I put myself in the position of financial freedom at such a young age without, the $1 million plus annual salary that maybe some of the conventional athletes make. And that's eventually what led to the idea of creating an investment opportunity that I thought best fit athletes. That was my whole original idea of the firm. And then when I launched, I was kind of blown away with how that message resonated with non athletes, right? It started with people in sales. They started hearing me talk and went, whoa, 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 this doesn't just apply to athletes. My clock starts over every year and I've got to go sell. And, how I perform basically just covers my lifestyle. And I can't get off this treadmill. And then it started resonating with, business owners that were like me prior to selling their business. And then that opened the door to YouTube influencers. And now you look at our, 600 plus investors, they are all over the board as far as what they do for a living. And that was really the whole gist of the firm. The secondary component is I wanted to spend a lot of time on education, because without that person coming into my life at a young age teaching me how to do this, I wouldn't be in this position today. So we spend a lot of time on social media putting out all free content around money management, credit, real estate investing, even investing in the market, kind of the tools that you need to learn to be able to go out and be successful as it pertains to your money.
That's important because a lot of people, even when people are managing somebody else's money, they themselves don't know how to manage their own money.
Right.
And I have seen that quite often. So that's how Commune Capital kind of started. So in today's aspect, right? So right now you got $325 million in under management, and you got a couple different style of asset classes. You got multifamily and storages. So talk to me about it. So are you into new builds? You buy existing? So what exactly is Commune Capital doing?
On the storage side, we do a strategy called adaptive reuse. So we go look for big box retail that goes vacant. Your, Walmart's, Kmart's, Toys R Us, stuff like that. And we keep the existing structure and then we fill the inside with storage units. And then once we're finished, we bring on a third party property manager. And then, we get to lease up, we potentially do a cash out refi, and then we hold our assets long term. On the multifamily side, it's ground up development. So, like storage, we do want to find something that's distressed that we can, potentially buy at a discount. I want it in a high demand market and I want it in a difficult market to build. And then we go through the entitlement process, the permit process, we build it, we hopefully get to the point where we can do the cash out refi and then we hold long term. So there are some similarities in the two, but the big difference would be storage. We primarily invest outside of California. Multifamily, we're all in California. And then it's ground up versus adaptive reuse.
Okay. So what markets are you in terms of storage? Let's talk storage first, and then we'll come down to the multifamily.
Okay, so storage, and the hardest thing about storage is it's very hard to get concentrated on one market, more specifically with how we do storage. So our portfolios are all over the place. They're in, properties in Ohio, in Washington, in Illinois, in Indianapolis. I'm not able to get hyper focused in one area the way I am in multifamily. Multifamily, we're more specific to certain regions, or even, we have areas where we're hyper focused on a certain city.
Now, for adaptive reuse, I believe most of these structures that you are leasing, I believe you are leasing them out, right? Because Walmart itself is leasing those spaces out, or Walgreens or CVS. And when they go vacant, I believe you are leasing them out to kind of then sublease. It's kind of like a rental arbitrage, but slightly different sense.
Actually, a little bit different than that. So we'll come in and we do mini storage. So we'll basically get rid of the whole inside, and we'll put anywhere from, let's call it 1,100 to 1,500 storage units inside that building, and then an individual will come in and rent one or potentially multiple of our storage units. So it operates, or maybe it looks more like a rentable apartment just on the storage side.
Yeah. So these are more like climate controlled, right? So because Yeah.
Correct. Correct.
Let's take a typical deal. Like, of course, every deal is different. So when you are leasing that space out, what's the typical size of that location of that building, and what's the rental that you are kind of paying? Then, walk me through the life cycle of it. Then you are adapting it. What does that each? How many storage units can you fit in there, and what's the typical size of that? What does it cost? So let's walk through the life cycle of this business.
Okay. So on the size, we're typically looking for something that has about 100,000 feet. And we typically need to get two stories of storage, which will get us closer to that, north of 1,000. We would typically need to be north of 1,000. We like to be closer to the 1,500 unit standpoint. As far as cost goes, it's all over the place. We'll have a project that, might be a $3 million equity check. So call it a $10 million total cost, or we'll have some that are larger that are, closer to the 20 total cost. How we end up looking at it, which will maybe be able to take us to like an overall portfolio level, is we're focused on unlevered, untrended yield on cost and what the spread is from current cap rates. So we typically want to see about 200 basis points from where cap rates are and where our yield on cost is. So, if you can buy a new storage unit at a 5 cap, we want to be able to kind of, I guess, build it to a 7 cap, if that makes sense. The hardest part, and here's the part that makes storage how we do difficult, is our biggest hurdle is not finding the deal. It's not finding the square footage or the, project level returns to make sense. It's the city. But by far, it's the city. Cities don't typically want to let operators like myself come in and turn what was a retail hub that, employed potentially hundreds of people, brought, X amount of dollars of sales tax into the city, and turn it into a storage property that has one on-site manager and, a fraction of the property tax or the sales tax. That's usually where projects go to die for us. It's usually the city not allowing us to do it. That's the hardest part.
It's a, I mean, cities needs to understand that, because if you are actually stabilizing that property, otherwise it's vacant.
Correct.
And vacant property is not producing them anything.
Yeah.
Or rather, when you're stabilizing it, it not only stabilizes that particular parcel or that particular, shop within that whole structure, but it also kind of enables and stabilizes 10 other businesses surrounding that.
Correct. That you're right. The hardest part is most cities that you go to, when you look at their breakdown of council members, they don't typically come from the real estate world, or at least this type of real estate world. You will get real estate agents, but you don't get a lot of real estate investors, and you unfortunately don't get a lot of people that are in the business building sphere as well. So they don't have the economic foresight that you just laid out. They're typically just focused on what it was, and they want that again, if that makes sense.
Or leave it vacant.
Yeah, unfortunately, yeah. We have a strategy that we found that gets cities to say yes to us more, but the majority of our deals die with city council for sure.
Okay. I mean, that number that you initially gave me, it was like a total cost, but let's break it down a little bit, right? So when you're leasing these units out or these shops out, what's the typical Walgreens or a Walmart that you have noticed?
I would say the majority of properties that we go after are probably Kmart's or Walmart's. Those ones tend to be a lot of the purchases we've made. The structure itself, I would say we need it to be north of 100,000 feet. So hopefully a little bit bigger than that. And then the cost ranges. We have 9 properties right now. We sold 2 a couple years ago. They've all cost something different because our areas are so spread out. Project that we built in California is not going to compare to what the current price on a project in Ohio is.
But do you lease them or you buy those?
Do we lease or buy what, the property?
The property is.
We buy it.
You buy it. Okay. So you buy that building that Kmart was previously kind of owning, or okay.
Correct. And then we go and fill it with storage, and then we lease out the individual storage units to people.
And those storages build them double story, right? So you got a first floor and the second floor.
Correct. It doesn't always line up to where, in a lot of areas, there'll be parts of the building that might be one story, but then in the center focus, it's the second story. I don't think we've ever found a project that was adaptive reuse that we could get to our numbers without doing two stories. The two story is critical for us.
Got it. And what does each pod kind of typically cost you?
Oh, you know what? That's a good question. I don't know what the price per pod breaks down to, but the last project we built in Indianapolis, or maybe even Ohio might be a better example. Our total cost was about $16 million for our acquisition, for our construction cost, and financing costs as well.
And now that you have exited out of some of these storage concepts that you're doing, what was the return that you noticed on those?
What was the return?
Hmm.
Okay, so how we structure our storage portfolio, everything is inside of a fund. And then when we, bring on, so we've had this fund now for a long time. If there's opportunity that, we can use the cash flow from our fund to go and buy, we do that. If we can't, that's when we open the fund up for new investors to come in, which that storage portfolio has been open for 4 times. What the return has been, historical return out of our storage portfolio has been about a 20.5% average or annualized return. That has been done primarily through cash out refis and then 2 exits of properties.
Awesome. That's a very sweet return.
We have a project in there that was a kind of the nice thing about the fund structure, and this is good for investors to know. When you create a fund, the admin of the fund is much easier than syndicating individual projects, but it's a lot harder to raise money for a fund. So that's kind of the most important thing to note. Some of the good things about the funds is you can have one project that really overperforms. You could have a project, unfortunately, that underperforms, and then you get everything in the middle to balance out what the overall return is for investors. And that's exactly how our storage portfolio looks. We've had a couple projects that were just phenomenal. One was an absolute grand slam. We've had a couple that, had hurdles that, underperformed what we were targeting. And then the blend of everything ended up being a very good return for our investors. So I would say that's one of the pros to a fund. You get diversification, which helps limit downside.
Yeah, and when people are talking about asset allocations and diversifying their portfolio, a fund is another way to kind of diversify within the real estate your investment, because now you're not just banking upon one project, but it's being diversified further with 10 different projects, although they are still with Commune Capital. Let's move on to the next topic, which is the multifamily. So let's talk about that. So why multifamily?
Oh, well, originally why multifamily was one, I saw an opportunity was driving more and more people in our state towards apartments and out of single family. And then the secondary part is coming from the skateboard industry and then into the beer industry. I felt like one of my skill sets was around marketing and experience. And when I was looking at multifamily, I felt like that was the ultimate experience because it's where somebody lived, somebody's home. And so I thought I had a strategy that I could add that would make our real estate more desirable and more valuable than some of my competitors. And then, what we saw over the last decade is definitely feels like the state is pushing people towards multifamily and away from single family, which means more demand on an already undersupplied asset class. And so for me on multifamily right now, from the economics of it, it's everything I want to see. And then from a strategic standpoint, I still feel like we have the opportunity to separate ourselves from our competitors. That's mainly done through design and some experience-based features in the apartment.
Let's talk about the experience-based features. So what is it your MSP over there?
Okay, so they range all the way from very basic things like making sure you have ports for your phones in the walls, from anything like digital features, your digital key lock, the very basic stuff, maybe going more kind of extreme into it. I want all of our apartments to have an aesthetic that a content creator would want to pull at their phone and film. So the idea is I want all of my tenants to want to pull out their phone and film a story seeing our building, and then the viewer go, where the heck is that? I want to live there. And then going more into some of our newer projects, we have a co-living apartment that we just completed that is very experience based and also offers a product into a very expensive market. So what we did was we built a 27 unit apartment, but the units primarily are 3, 4, and 5 bedroom units. They bedrooms per unit. Apartment comes fully furnished, and then we also offer a maid service on property as well. And then the leases are tied to the bedroom, not the unit. So what does that mean for the experience? One, for your 21 to 30-year-old who needs roommates, this offers a great solution for that roommate market. The apartment is stunning. You don't have to furnish it. You get the cleaning service, and it's much cheaper than what the alternative in the market would be. And then even all the way to how you lease it up. There's an app feature. You can get very specific with who your roommate is going to be. So you get an option of pairing that I think is pretty rad for the time that we're living in.
I've heard about, co-living spaces,
Mm-hmm.
but the way you are doing it is definitely you got MSP over there, so it's quite unique what you're doing.
Yeah. And then on top of that, we do have like our just market rate build to rent product. And then that one is more on the aesthetic. Like for example, we have a project in North Park, San Diego that we it was originally a duplex and it was on a very small lot. I think the lot was 6,000 feet, maybe a tick over 6,000 feet. And we ended up building an 8-story, 32 unit apartment on it, right? Which is, for anybody who knows real estate, that's a very big project for that little of a footprint. And so we got very creative with how we did the parking. We have a parking structure that has a rotating parking lot that some we found people using in Europe. So basically, you pull in, park your car, you move out, and the system moves the car up and opens up a new spot and rotates, which is how we did our parking lot. It's all studios, very high ceilings. It's a masonry build, and it is just beautiful. The units are probably only 400, maybe 450 square feet. They feel humongous. I mean, they're massive feeling. So that was just one way of us trying to maximize space and have a creative place where people wanted to go, where when they looked, at their neighbors, which was just maybe a basic, call it podium build, they felt like they were in something superior. And then if our rents are the same as the neighbor, then we end up doing pretty well.
Great. And how's your real estate portfolio in terms of returns? How's those funds doing?
Okay, on the multifamily side.
Yeah.
So on the multifamily side, we have a lot under development right now. We sold 2 projects. Let me see. We sold 2 and 22. And from a project level on one of them, which was a value add, it wasn't a development. I think we did about a 15.5% IRR. And then the other one was an entitlement project that we ended up selling the paper on. And I think on that one, it was about a 20, I want to say about a 22% IRR on that one. And then everything else right now is we're holding, we're not selling.
Okay. In terms of your geographic spread within California, because multifamily you are doing in California, right?
Yep.
So, what parts of California are you doing that? Is it around you, or is it kind of varies?
So the market that I am the most focused on right now is a city called Ventura, where we have 3 projects. And then I have another project that we developed in about 2015, 16 that is in that area as well. It's a 115 unit apartment. I have 2 projects in the LA area. And then the next area that I'm really focused on is North Park. So I would say Ventura and North Park are the 2 areas that I am aggressively buying. And then starting the beginning of May, I have an apartment project closing every month for about 12 months, all throughout the valley and into North Hollywood, that are actually all affordable housing projects.
So, with current interest rates, how are you, when we talk about multifamily? And I have spoken to some other fund managers or syndicators in the last few months. Everybody's talking about either they have sold their portfolio and whatever portfolio is left, it's kind of a little bit in stress, or they were kind of lucky, or how the market is bleeding because of the high interest rate, high labor cost, high depressing rents and higher inventory, the material cost. So everything on the crossroads of it is kind of becoming, let's say, unprofitable for this business. And especially those loans, those bridge loans, or those loans are now kind of coming to the junction where they have to be refinanced at this point of time. So the loans that were made out in 2020, which were in low, and now you are looking at maybe at 8 or 7.5 or 8.5%. So how are you, the market and the economic, there is so much of distress, right? And there is so much of bleeding in the market going on. So how are you making these products either profitable, or what's your strategy around it?
That's a really good question. Okay. So the first thing that's important for kind of the listener or viewer to know is real estate is very fragmented. So what works in certain areas will not work in others. One thing that is consistent, though, that you mentioned is if you were a builder or even did something like a deep value add where you used bridge debt, let's call it in 2020, even 2019, and you are now at the point where you're having to refi out, that is where the distressed real estate, in my perspective, majorly is, because the banks aren't lending at the amount they were when you went in. Cap rates have moved, which means your value has come down. That is where I think the distress is typically happening. So if you are a, let's say, seasoned, well, actually, before I even say this, there's a secondary part to it. Depending on the city that you're building in, if that city is easy to build, you are also seeing areas where so much development has happened that the market is just saturated. Austin is probably the newest example, right? Austin rents have corrected by about 22%. Supply wasn't added, so you started seeing prices run up. Well, in those markets, it's easy to build. And even in areas like Austin, they made it easier than it originally was. In Austin specifically, they added 50,000 new apartments into the market. And when you do that, you will get to a point where vacancy increases. When vacancy goes up, you have to give rent concessions, which they're doing right now, which then cap rates are going to follow. And then your building is going to halt and the market's going to crash. For myself and my company, the first thing that we have to do is look at our portfolio and go, is our portfolio okay? Or do we need to spend this opportunity where we should be buying to salvage our assets? Now, for us, we didn't have to do that. And so we didn't have anything that was that pressing that made us go, we can't look at buying. We need to be in survival mode. If you're going to buy a stabilized property, you're basically doing it all cash. Value add stuff, I don't know how they're doing it. That doesn't make sense to me on how it's working. What we have found works is development, where you can build it to a higher cap rate. And then kind of the caveat is we're coming in with way more equity so that we're avoiding the typical 3-year bridge loan and we're doing more mini perm loans. So we're giving ourselves the opportunity for our construction loan to roll into our permanent financing. But that means you're coming down with 40 to 45% equity as opposed to a few years ago. I mean, some groups are coming in as little as 5 to 10%.
Yeah. And what are the interest rates that you see right now?
The last loan that we did, we got our construction loan at about 7.5, I believe. I think that one came in about 7.5, 7.5.
Okay. And when you say mini perm, so what was the conditions on that?
So mini perm basically means that you can get a total of 10 years. And if the environment isn't worked out in, let's say, 3, you don't have to panic. I say put yourself in a position that a lot of the distressed developers are in right now. But if you asked me, and I'd be curious to get your opinion on this, I think interest rates are worked out in 3 years. I think there's a higher probability that they're worked out in 3 years than they're worse than they are today. But for us, we just want to protect ourselves in case that scenario doesn't happen.
Yeah, you're right. I mean, that protection is needed. Like I was talking to another gentleman, and we were discussing about how back in the day, you could get like a 30-year fixed kind of a offset, or I forgot the term, but like insurance. But it used to be like 50 or $80,000, but now it's like way, way, way expensive, right?
Yeah.
So yeah.
Yeah.
So
Yeah. So it's look, there's pros and cons to it. I'm a big believer in maximizing upside while limiting downside, but that's not everybody. There's people I'm talking to today that truly believing that, you know, use leverage right now because this thing is definitely getting worked out in 3 years, which is going to mean their returns, if they're correct, will be higher than mine. But if they're wrong, I don't want to be where they are.
absolutely. And especially when you're dealing with other people's money, I think that's more important to minimize the risk.
Right.
Uh, Although that means that you are also somewhat limiting the profits, but I think
Yeah.
you should maybe err on the side of the risk than on the profits, right?
That's right. If you're using other people's money, the last thing you ever want to do is lose their money.
Exactly.
It is a reputation hit that takes a long, long time to get past. So be mindful of that, especially when you're getting started, because I think that's where you feel the most pressure to be competitive and offer up something better than the experienced ones. You're just bringing on a lot of risk with that. So you want to be aware of what that risk is.
What's the biggest challenge that you see with the market and with economy where we are with, well, today is second, right? So with the tariffs that are kind of gonna go into effect and everything else that's happening around us or that you think might happen, so how it's gonna shape up?
That's the $1 million question, huh? That's the $1 billion question. That might even be a $1 trillion question. Um, well, okay, something like the tariffs, and I'm not saying this. Don't think that I don't understand the negative implications of tariffs. I do. I am less concerned with the tariffs personally. As far as real estate goes, I'm not so focused on that. The thing that concerns me with real estate is it's more regulation. The regulation and the government in a lot of areas trying to get more involved and solve something like a housing crisis through government regulation, that's something that I'm probably most concerned about. I would say another part is depending on your market, and let's use Southern California for example. Rents here are so high to buy a house here, right? In my neighborhood, your starter home that's 40 years old, the median home price for that is $1.1 million, right? So you really need to make north of $300,000 a year to comfortably afford the old starter home. We're entering into a place where how are the next generation going to own homes? That's good if you're a multifamily investor. That's bad for society. And so I definitely am concerned about what the next generation has. And I think that's being done with government involvement, but it's being marketed as an issue with capitalism, not with government doing too much. That's where my big concern is.
Fair point. I mean, I have seen that regulation into all aspects of it. I'm a short-term rental investor myself, and we see those kind of regulations happening into our industry as well,
Yeah.
which kind of negatively impacts the viability of the projects that we are in.
Yeah, that's right. But to give you like more of a real estate focused answer, for me personally, I'm not really concerned about cap rates in the next 2 to 3 years. I'm actually not even really concerned about interest rates. When I'm looking at something, I want to first and foremost know that there's going to be demand for 10 years. Will this product have demand 10 years from now? And can we hit the rents we want to hit? If the answer is yes, and we have removed things from the table that would force an exit at a not opportune time, I don't care what happens in the interim. And so I think if you can be on a longer timeline and you're preparing for factors and that the project will still make sense if those happen, I don't think the interim matters so much.
So, what's a typical between all your different products? Of course, it's switches a little bit, but what's the average cap rate that you get for your multifamily, and what's the average cap rate that you get for your storage units?
Okay, so on, you want me to give you like cap rate that we're valuing at, or do you want to? want me to give you cap rate that we're buying at, or all?
Well, let's talk about all.
Okay. So for our multifamily stuff, we're typically not buying existing Class A apartments, but in our area, cap rates right now being softened are somewhere north of 5%, 5.1, 5.2. Because we're buying distressed assets, I mean, sometimes there's no revenue coming in. So we're more paying a price per square foot on land. And then we're building to hopefully about a 7% yield on cost. And then when we're underwriting our projects for our potential cash out refi and then potential exit, which is how we're modeling our return, we use CoStar's forecast on what that looks like. On some of our newer projects, we're looking at about a 4% cap rate in, I want to say maybe in 28. And that's the forecast they're giving us. And then we're using about a sub 4 cap 5 years from now. So about a 3.8. Now, the caveat to that is we stress test this cap rate. So prior to us moving forward on a deal, if we're expecting to do a cash out refi at a 4 cap, we're looking at what it looks like if the cap rate moves to 5.5. And if we can still make money, that's typically the sign that we're going to move forward on. Cap rates for storage, because we're in different markets, they are all over the place. So, maybe the best way to say it, if we're going to build one, I want it to land about 200 basis points north or have a 200 basis point spread from where current cap rates are.
Okay. And what's the typical current cap rate on the storage? 5%?
It ranges on the market. So, we have a project out here where cap rate's going to be actually a little bit sub 5. And then we have projects, let me see which one is not performing well. We have a project in Illinois, right? That cap rate's probably north of 6. So they're all over the place for us.
And what's next for Communal Capital?
All right, the newest offering for us is an affordable housing fund. Something that the city of Los Angeles just passed is a streamlined entitlement and permit process with discounted fees if you do affordable housing. And so the typical 3+ years that we spend getting a project entitled and permitted, you can now do, in some cases between 6 to 8 months, which is it's a big deal for real estate developers. That's the next thing we're doing. They all sit sub 40 units, and they are kind of offering a product into the market that is needed. Now, if you were to ask me, I probably wouldn't solve that through government subsidies, but this is how they chose to do it. They've opened up a window for investors to get product online fast. The return that we're looking at actually looks a little bit higher than our market rate product. So the demand's there. The incentive was created from the local government. The return's there. So that's the next initiative that we're doing.
Okay. And what's the potential return that you're looking at?
On that one, it's, if I remember right, I'm looking at a 19% net IRR, and I think that shakes out to about 21.5% average annual return.
Awesome. And what's next in life for Mikey? I mean, you are a man of adventures, right? So there has to be something next.
Yeah. So we have our company goals. Our next immediate goal is doubling the AUM. Our target is 3 years. So we'll want to be at just short of 700 million in 3 years. We then have a target of $1 billion under 5. So that's kind of the AUM goal. As far as me personally, I'm raising 4 kids, so I want to give the best example to my girls on what a husband looks like, so that when they go out, I did my job. I want them to have all the tools capable that they would need to then go out and be impactful. For my son, I'm trying to show him what a man looks like, so that he can grow up and do much more than I did. And then what's after this? I don't know what goes beyond that. That I have my hands full for 5 years for sure. So I'll start working on my 10-year plan maybe next year.
Righty. Well, I appreciate it. There's a lot of interesting stuff that we covered in this thing. We really appreciate you being part of this show. So, Mikey, if people want to contact you in regards to your advice for investing or they want to invest with you, what's the best way for them to get hold of you?
So if you want to find me and just want to hear what I'm about, I put out a lot of content that's educational. You can find me on all of the platforms, just Mikey Taylor. My company is called Commune Capital. If you want to hear about what we do, it's communecapital.com. And you will have the opportunity to put in your information. One of the members on our team will send you information on the new offering. We'll see if we're a good fit for one another.
Thank you. Thanks, Mike. And to our viewers, thanks for joining in. And we'll be back with you next week with another show of Bigger Life Podcast, more inspirational stories, how to invest in real estate, how to be successful. And thanks for joining. Thanks, Mikey. You have a good one.
Ray, thanks for having me.